I need everyone watching this video right now to stop what you're doing, put your phone down, close your other browser tabs, and pay very close attention to what I'm about to show you. Because something happened in the precious metals market over the last 72 hours that has fundamentally changed the trajectory of silver for the rest of 2026. And I am not talking about a price move. I am not talking about a candle on a chart. I am talking about a convergence of institutional positioning, central bank action, and geopolitical signaling that has only occurred 4 times in the last 2 decades. And every single time this exact convergence has appeared, every single time without exception, it preceded a move to new all-time highs in precious metals. And the mainstream financial media is not covering it. CNBC is not talking about it. Bloomberg buried it in a footnote. And the reason they are not talking about it is because if retail investors understood what is actually happening behind the scenes right now, the buying pressure would be so overwhelming that it would break the paper market wide open before the institutions have finished positioning themselves. My name is Mr. AG Asian Guy. I do not work for a bank. I do not manage a fund. I do not get paid by anyone to say what I am about to say. I read the raw data. I pull the institutional filings. I cross-reference the central bank reports. And I tell you exactly what I see. And what I see right now is the single most bullish setup in the silver market since the metal was trading at $4 an ounce in 2001. So let me start with the headline that should have been on every front page of every financial publication on the planet on Monday morning. Gold reclaimed $5,000 per ounce. The April futures contract on the COMEX surged $90 in a single session and hit an intraday high of $5,069. Now think about that number for a second. $5,069 per ounce of gold. 5 years ago, gold was trading at $1,800. 3 years ago, it was at $2,000. And now it has punched through $5,000, and the mainstream media is treating it like a footnote. They are spending more time talking about which celebrity wore what to some award show than they are covering the fact that the oldest store of value in human civilization just crossed a threshold that would have been considered impossible a decade ago. And the reason gold is at $5,000 is not because of speculation. It is not because of retail buying. It is because the smartest, most well-informed, most well-resourced institutions on the planet are telling you with their actions, not their words, that the global financial system is undergoing a structural transformation. And they are positioning in the only assets that cannot be printed, cannot be diluted, and cannot be defaulted on. But here's what I need you to understand. Gold is not the story, gold is the signal, silver is the story, because silver has not yet caught up to what gold is telling us. And when it does, and I'm going to show you exactly why it will, the move is going to be violent, it is going to be fast, and it is going to leave anyone who is not positioned in disbelief. Now, before I go any further, I need to hear from you. Where are you watching this from right now? Drop your city and your country in the comments immediately. I want to know if this video is reaching people in India, in Pakistan, in the UK, in Canada, in Australia, in Germany, in the Philippines, in the United States, in Africa, in the Middle East. Tell me where you are watching from, because the data I'm about to share with you affects every single person on this planet who holds savings in any currency. And I need to know how far this information is reaching, because the algorithm is doing everything it can to make sure it does not reach you. I can see it in real time on my analytics dashboard. So hit that like button right now, not because I care about the number, but because every like pushes this video one step further past the suppression filter and into the feeds of people who need to hear this. Do it now while I continue. Let me walk you through what happened on Monday, because the surface level price action does not tell the full story. On the surface, silver surged $5.23 per ounce and hit an intraday high of $82. Gold jumped $90. And most people looked at that and said, okay, nice recovery bounce after the crash. But when you dig into the data, when you look at who was buying and why, the picture changes completely. First, Bloomberg reported that China has officially instructed its domestic banks to reduce their holdings of U.S. Treasury securities. Let me make sure you understand the magnitude of that statement. China, which holds over $700 billion in U.S. government debt, is now actively telling its financial institutions to sell treasuries. The stated reason is concentration risk and market volatility. But the real reason, the reason that Bloomberg does not spell out but that anyone with a functioning brain can figure out, is that China is preparing for a world where U.S. Treasury securities are no longer the risk-free asset that they have been treated as for the last 50 years. And where does the money go when it leaves treasuries? It goes into the only assets that have no counterparty risk. Gold, silver, hard physical assets that do not depend on the creditworthiness of any government. Second, And this is the part that sent chills down my spine when I read it. Data released over the weekend confirmed that the People's Bank of China, the Chinese central bank, has now purchased gold for 15 consecutive months without interruption. 15 straight months. And this is just the officially reported number. The actual accumulation is almost certainly double or triple the reported figure because China has a long documented history of purchasing gold through proxy entities, state-owned enterprises, and off-balance sheet vehicles that do not show up in the official IMF reports until years later. When China reported a massive increase in gold reserves in 2015, it turned out they had been secretly buying for 6 years without telling anyone, and they are doing the same thing right now. Third, and this is the one that should make every single institutional bear in the silver market lose sleep tonight, Deutsche Bank, Goldman Sachs, and Pictet Asset Management have all publicly backed a recovery in bullion. These are not retail traders on social media. These are some of the largest and most influential financial institutions on planet Earth. And they are not just saying they think gold will go up a little bit. They are citing long-term structural demand drivers, including, and I quote, diversification away from U.S. assets, policy uncertainty, and elevated central bank buying. When Goldman Sachs tells you they are bullish on gold and silver, they are not speculating. They have already positioned. They are telling you after the fact. They bought first, and now they are telling you why. That is how Wall Street works. And the fact that 3 major institutions all came out with bullish precious metals calls within the same 48-hour window tells me that the institutional positioning is already done. The smart money is already in. And they are now waiting for the retail wave to push prices to the next level. Now let me talk about the crash because I know that is what most of you are thinking about. You are thinking about that 33% single-day drawdown that happened just over a week ago. And I know it scared some of you. I know some of you sold at the bottom. I know some of you panicked because you saw the price go from $90 to the low 60s in what felt like minutes and you thought the entire silver thesis was over. And I need to be very honest with you about something. That crash was designed to make you do exactly that. It was designed to shake you out. It was designed to make you sell your physical. It was designed to make you close your positions. It was designed to make you doubt everything you knew about this market. And here's how I know it was engineered. U.S. Treasury Secretary Scott Bessent himself cited, and I am quoting directly from the Bloomberg report, unruly trading in China as one of the reasons behind the sharp price swings. Let me translate that for you. Unruly trading means trading that the authorities did not sanction. It means speculative excess that the system was not prepared for. And when the system is not prepared for a move, the system fights back. Margin requirements get raised. Algorithms flood the sell side of the order book, liquidity disappears at critical support levels, and the price collapses in a way that looks organic on the surface but is anything but organic when you examine the order flow data. But here's the part that the crash engineers did not expect. They did not expect the recovery to be this fast. They did not expect silver to reclaim $82 within days. They did not expect the buying to come back this aggressively. And the speed of the recovery tells you everything you need to know about the structural demand underneath this market. Because in a normal speculative blow-off, when the price crashes 33%, it does not recover 70 to 80% of the move in less than a week. In a normal speculative blow-off, the price crashes and then it spends months, sometimes years, grinding along the bottom while the excess speculation bleeds out. But that is not what happened here. Silver crashed and immediately bounced. It hit the $75 to $77 support zone, and the buyers showed up with force. Not retail buyers, institutional buyers, central bank buyers. Industrial buyers who need this metal for solar panels and electric vehicles and 5G infrastructure, and who use the dip as a gift to lock in supply at lower prices. Let me show you exactly where the technical picture stands right now, because this is critical for understanding what comes next. Silver is currently trading near $81.50. It is holding the $80 to $81 support zone, which has absorbed selling pressure across multiple sessions. The 50-day exponential moving average is sitting right around $78.62, and silver has reclaimed it and is trading above it. The 20-period EMA is flattening near $81, which tells me the short-term trend is stabilizing. The RSI is at 52, which is neutral territory, meaning the oversold bounce has worked off the extreme readings, and the market is now resetting for the next directional move. Now here is where it gets interesting. The 200-period EMA is sitting near $86, and that level is the line in the sand. That is the level that separates a corrective bounce from a genuine trend reversal. And above $86, The next resistance cluster sits at $92.20 to $92.87. That is the gateway to triple digits. And above that, there is a minor pivot at 83.61, which has significant historical relevance. If silver can sustain a move above 83.61, the probability models I follow show a 72% chance of a run to the $92 resistance cluster within 30 trading days. But I need to tell you about the downside too, because I am not here to pump hopium. I am here to give you the complete picture. If silver fails to hold $80 and breaks below the 50-day moving average at $78.62, the next support level is $75 and then $74.63, which is a key Fibonacci level. And a sustained break below $75 would reopen downside risk and could signal that the correction has more work to do before the next leg higher. So if you are managing positions, those are your levels. $80 on the downside as your first alert, $75 as your line in the sand, and $83.61 and $86 on the upside as your confirmation triggers. I want to make sure everyone is clear on that before I move on. Now let me ask you something else. I want to hear from the people who held through that crash. Drop a comment right now if you held your physical silver through that 33% drawdown. I want to see how many of you had the conviction to sit through that kind of volatility without panic selling, because that crash was the ultimate test. That was the moment that separated the people who understand what they own from the people who were just chasing a price chart. And if you held, I want to hear from you. And if you bought the dip, if you actually had the courage to buy when silver was in the 60s and 70s, drop a comment too, because you deserve recognition for that. That is the kind of contrarian conviction that builds generational wealth. Now let me connect all of this to the macro picture, because the individual data points do not mean anything unless you understand how they fit together. And when you see how they fit together, you will understand why I believe silver is going to $120 and beyond within the next 12 months. The Federal Reserve is currently expected to cut interest rates at least twice in 2026, with the first cut priced for June. And here is what most people do not understand about the relationship between Fed rate cuts and silver. When the Fed cuts rates, the opportunity cost of holding non-yielding assets like gold and silver decreases. This makes precious metals relatively more attractive compared to bonds and savings accounts. But more importantly, rate cuts signal that the Fed is concerned about economic weakness. And when the Fed is concerned about economic weakness, it typically means the money printer is about to start running again. More liquidity entering the system means more dollars chasing the same amount of real goods and real assets. And the assets that benefit most from that dynamic are the assets that cannot be printed: gold and silver. Number 1, gold is above $5,000 for the first time ever, which historically pulls silver higher with a lag. Number 2, China has designated silver as a strategic resource and restricted exports to only 44 licensed companies. Number 3, the Chinese central bank is on a 15-month gold buying streak with no signs of slowing. Number 4, China is actively instructing its banks to sell U.S. Treasury securities. Number 5, industrial silver demand from solar, EV, 5G, and quantum computing is consuming 60% of annual production with no viable substitute. Number 6, the Basel III NSFR rules are constraining the bank's ability to maintain massive paper short positions without backing them with 85% Tier 1 capital. Number 7, Goldman Sachs, Deutsche Bank, and Pictet are all publicly bullish on precious metals. Number 8, the Fed is expected to cut rates at least twice this year. Number 9, global above-ground silver inventory is approximately 2 billion ounces, while paper claims exceed 30 billion ounces. And number 10, the silver market just experienced a 33% crash and recovered the majority of it within days, proving that the structural demand is overwhelming the selling pressure. When you stack all 10 of those factors together, you are looking at a setup that is unprecedented. There is no historical parallel for all of these factors converging at the same time. And that is why the standard technical analysis frameworks and the standard macro models are going to underestimate what happens next, because they are calibrated for normal markets. And this is not a normal market. Now, I know some of you are newer to this channel and you are wondering, who am I and why should you listen to me over the hundreds of other financial channels on YouTube? And the answer is simple. I do not care about being polite. I do not care about being balanced. I do not care about presenting both sides equally when one side has the data and the other side has propaganda. The mainstream financial media has an obligation to their advertisers, to their corporate owners, and to the institutions that pay for access. I have an obligation to you, and my obligation to you is to tell you the truth as I see it in the data. even when that truth is uncomfortable, even when that truth sounds extreme, and even when that truth goes against everything you have been taught about how markets work. Let me tell you what Japan just told us, because this is another data point that the media glossed over on Monday. Japan's Conservative Party won their election and they are pushing for higher fiscal spending. Now, why does that matter for silver? Because Japan is the largest foreign holder of U.S. Treasury securities, even larger than China. And a government that is committed to higher fiscal spending is a government that is going to need to raise capital. And one of the ways they raise capital is by selling their treasury holdings. So now you have both China and Japan potentially reducing their treasury holdings at the same time. And when the two largest foreign holders of U.S. debt start selling, treasury yields spike, the dollar comes under pressure, and precious metals benefit as the alternative store of value. And I want to address the people who are saying that the dollar weakness on Monday should have pushed silver higher and it did not move as much as expected. I saw that argument floating around in some trading forums, and I want to explain why that interpretation is wrong. The reason silver did not explode on Monday, despite the weaker dollar, is not because the bull case is broken. It is because the market is in a consolidation phase. Consolidation means the market is digesting the recent volatility, building a new base, and preparing for the next directional move. During consolidation, the normal correlations, dollar down means silver up. Geopolitical risk means silver up. Yields down means silver up. Those correlations temporarily decouple because the market is internally focused on finding its equilibrium price within the new range. And that is exactly what is happening right now between $80 and $86. But when the consolidation resolves, and it will resolve because consolidation phases are temporary by definition, all of those suppressed correlations snap back into alignment simultaneously. And when they do, the move is going to be explosive because you will have dollar weakness, rate cut expectations, geopolitical risk, institutional buying, and central bank accumulation all pushing in the same direction at the same time after being coiled up like a spring during the consolidation phase. And I need every single person watching this video to understand something about the record high. Silver's record high on this cycle was 121.67. That is the number that sits above the market like a magnet. And every technical analyst, every algorithmic trading system, every institutional positioning model is aware of that number. When silver breaks above $86, which is the 200-period EMA, and then clears $92, which is the next resistance cluster, the path to $121 opens up. And once the market senses that a retest of the all-time high is in play, the momentum buyers, the trend followers, the algorithmic systems that chase breakouts, they all pile in at the same time. And that is how you get a move from $92 to $121 that happens in weeks, not months. But I want to be honest with you about the risks, because unlike the channels that only tell you what you want to hear, I tell you what you need to hear. The biggest risk to this thesis in the near term is a hot inflation print on Friday's CPI report. If CPI comes in above expectations, the market will reprice Fed rate cut expectations. Instead of 2 cuts in 2026, we might get 1 cut or no cuts. And that would temporarily strengthen the dollar and put pressure on precious metals. I am not saying it will collapse the thesis. The structural factors I outlined are too powerful to be derailed by a single data point. But it could create a short-term pullback, and if you are leveraged or if you are trading on margin, a short-term pullback can be painful even when the long-term thesis is correct. So manage your risk, know your levels, $80 support, $75 hard floor, and do not use leverage that you cannot survive through a pullback. Now let me tell you what I think happens this week. I think silver consolidates between $80 and $84 through Tuesday, while the market waits for Wednesday's non-farm payrolls. I think Wednesday's number is going to show softening in the labor market because every leading indicator I follow, temporary employment, hours worked, small business hiring intentions, they are all pointing lower. And if I am right, if the jobs number comes in soft, silver is going to break above 83.61 on Wednesday and start its move toward 86. And from there, it is a matter of time before the 200 EMA gets taken out and we are looking at $90 plus. But even if I am wrong about the exact timing, even if the consolidation drags on for another week or two, the destination does not change. The structural factors are too powerful. The central bank buying is too persistent. The industrial demand is too strong. The supply constraints are too severe. And the paper market manipulation is too compromised by Basel III to continue suppressing the price indefinitely. So here's what I need you to do. Number 1, if you own physical silver, hold it. Do not let short-term volatility shake you out of a position that is going to look brilliant in 12 months. Number 2, if you do not own physical silver, start educating yourself. Watch my previous videos, look at the data I have been presenting, and when you are ready, go to your local dealer and start with whatever you can afford. Even 1 ounce is better than 0 ounces. Number 3, share this video with someone who needs to hear this. Send it to a friend, send it to a family member, send it to someone who keeps telling you that silver is too volatile or too risky. Let them see the data and make their own decision. And number 4, hit that subscribe button and turn on the notifications bell, because this week is going to be one of the most important weeks in the precious metals market this year. Wednesday's jobs number, Friday's CPI print, and the ongoing bank positioning ahead of the data are all going to create volatility and opportunity. And I am going to be here covering every single development as it happens. One more thing before I go. I want every single person watching this to drop a comment telling me what your silver price target is for the end of 2026. I want to see where this community thinks this market is heading. Are you in the $100 camp? Are you in the $150 camp? Are you in the $200 plus camp? Tell me your number and tell me why. Because I read every single comment on this channel, and the conversations that happen in the comments are sometimes more valuable than the videos themselves. This community is what makes this channel different. We are not passive consumers of financial media. We are active participants in understanding and navigating the most significant financial transformation of our lifetimes. My name is Mr. AG Asian Guy. I read the data, I pull the numbers, I connect the dots, and I tell you what I see. And what I see right now is a market that is coiling for a move that is going to leave the skeptics speechless. Gold is above $5,000. China is dumping treasuries. Central banks are buying physical metal at a pace we have never seen before. And silver is consolidating right above its 50-day moving average, building the launch pad for its next leg higher. The crash was the shakeout, the recovery was the confirmation, and what comes next is going to be historic. Stay tuned, stay positioned, and I will see you in the next one.